Overall, we continue to believe that resilient economic growth and improving earnings provide a supportive backdrop for investors.
Welcome to this month's Market Outlook podcast. My name is Lorna Denny, and I'm joined by our strategist, Imric Forrest, who will be giving our investment team's perspective. Good to see you, Imric.
Good to see you, Lorna. Hi, everyone.
Now, you spoke last month about diverging forces acting on the markets with the conflict in the Middle East set against surging enthusiasm for AI investment. But these forces have since moderated to a certain extent, as we will come on to discuss. Could you perhaps, though, start by giving us a few brief market highlights for the past month?
Indeed, those forces have moderated. And when we looked at performance, the recent strength of the tech, the AI theme, indeed took a pause in June. Although equity markets continue to move slightly higher, supported by positive macro and geopolitical news, indeed the reopening of Hormuz. European equities, global small cap value stocks led mainly and outperformed in June. And they outperform growth and tech-related regional indices such as what we can find in emerging markets or even in the US, the S&P 500. I talked about it before being quite concentrated on US tech. But if we look at year to date, although there's been this pause in June and it's kind of continuing in July, emerging markets, small cap, Japanese equities have delivered most returns, so respectively 27% and around 20% for small caps and Japanese equities in euro, whilst European equities stocks were up 10%. So it's quite a big difference in terms of performance. Especially because on the currency side, the US dollar was up 2.5%, so it hasn't really been driven by currency. So dollar stayed relatively resilient, and that has been a reflection of the relative strength of the US economy. On the bond market side, they were quite steady for the months. European bonds outperformed a little bit. There was a bit of volatility because of changes of expectations for the ECB or the Fed. And those expectations, obviously have been driven by changes in the oil prices. And as oil prices fell, concern about inflation shock has eased. Although central banks remain cautious. We'll talk about that probably later. And credit has still outperformed government debt year to date and over the month. And finally, I talked about oil briefly, but oil was down another 16% in June and returned to pre-Iran conflict levels, so below $70 per barrel was the WTI. Gold, we talked a lot about gold at the start of the year. It was investors' darling, retail investors' darling to try to diversify geopolitical risk. It suffered another setback, so it was down 9% because geopolitical tension eased, also because of this dollar that still remained relatively firm, and again some profit taking after 2 very strong years for gold investors.
You said there that tensions cooled in the Middle East and the price of oil has come right back to pre-war levels. So does that mean that the risk of a sharp spike in inflation is now behind us? So
obviously what the recent acceleration in inflation we observed was related to oil prices. So any easing in oil prices is obviously encouraging because it reduces the risk of an energy-driven inflation shock. But I wouldn't say inflation has disappeared as a concern. The bigger picture is that economic growth, particularly in the US, still remains remarkably resilient. We talked about it previous months, but AI and AI investment has been a strong driver, especially in the first quarter of the economic growth in the US. Labor market is still healthy. Consumer spending held up well. So while lower oil prices help, central banks still needs to be confident that inflation is moving sustainably towards their target. And our base case remains that gradually we'll see inflation moderating rather than a rapid return to very low inflation.
You mentioned the inflation, of course, and that must bring us on to thinking more about central bank policy. And markets read the first press conference by Kevin Walsh, the new Fed chair, as hawkish, that is to say, indicating an interest rate hike. Has that possibility now faded, do you think?
So I mean, that was an interesting conference because he said he will not talk much. He didn't talk much. He just had to focus on what really mattered. And obviously, when you have 4.2% CPI printed in the US, you can't ignore inflation. So the Fed's message and Walsh's message was very much focused on that, just top of the agenda. It would have been weird had he said anything else. But that said, we don't think central banks are trying to slow the economy. They're simply looking for greater confidence that inflation is under control. So while policy is likely to remain cautious, our expectation is still for a gradual normalization rather than a prolonged period of higher rates. We've seen it with the ECB as well. Lagarde said, okay, we hiked. It was probably the right thing to do. Now we're going to pause and observe. Again, we have to be cognizant that we are in a higher rate, higher inflation regime compared to post-Great Financial Crisis. And sticking to the data, continue to observe and take sort of careful, proactive action is probably the right policy at this time. Sorry.
Indeed. If we switch to the corporate front now, earnings have seen consistent upward revisions so far this year. Is this all AI driven?
It was incredibly strong, and analysts have completely revised upwards their expectations after the release of it was Micron's first quarter. And from that moment onwards, surprise after surprise, we continue to revise higher the earnings for the quarter and for the subsequent quarter, and therefore for the year. So now the S&P 500 is expected to grow its earnings by 23% roughly for the year. So AI has certainly therefore been an important part of the story. We discussed last time, it was driven by semiconductors. They're growing year on year, like 90% of their earnings, and likely to grow another 30% next year. But it's not the whole story. We are starting to see, and we may see in the second quarter, some greener shoots, some healthier earnings from other sectors, simply because the economic activity has been quite resilient. One thing to watch carefully is obviously on the AI side is a very large amount of capital being invested into AI infrastructure, but also the return on investment, and that will be a function of, for example, the price of token, AI token. So when you want to use Claude or GPT, at some point you may have to pay. And this price fluctuates. And obviously, if the price of those tokens drops because of supply-demand imbalances, it makes some of those investments less profitable. So, same, the cost of producing energy, data center extra, all the profitability of those investments will be scrutinized. But we can't ignore it. It's still an area investors should continue to monitor. But we have to be conscious of valuations, of expected growth as well in this domain. And the coming quarters will give us a bit more clue about the sustainability of those extraordinary growth rates we've seen in the first quarter.
Yes, well, you mentioned quarters, but it's second quarter earnings season is really fast upon us now. And would you expect any evidence of a broadening of earnings acceleration moving beyond the AI sector in these Q2 earnings figures?
Yeah, I was kind of alluded to greener shoot elsewhere. Although in the second quarter, earnings growth is going to be dominated by energy, because obviously energy prices were extremely strong in the second quarter. Still tech and materials. So we've seen as well some robust prices, copper and other mining. But if we look at the other sectors, we still expect to grow. I think only the healthcare sector is expected to deliver year-on-year negative growth in the second quarter. So we are seeing some improvement aligned with this theory of broadening of earnings growth. That would make any equity markets rally healthier. So you don't depend just on some small group of technology stocks to go higher. And that's definitely something investors will pay close attention during the upcoming earnings season.
So, what adjustments have we made then to our asset allocation?
So the asset allocation hasn't changed much. We remain constructive on risk assets. We continue to hold a moderate overweight in equities. We had a preference for US and emerging market equities because earnings momentum was strong. We still keep it. However, because of exceptional performance of global technology, we've taken some profit from our dedicated technology allocation. That's simply prudent portfolio management after such strong gains. Although we still have a meaningful technology exposure through US and emerging market holdings. Within fixed income, we continue to further global high yield bonds, emerging markets, our currency debt, where we see an attractive income opportunity. So it's just harnessing the carries income provided by those asset classes. But overall, we continue to believe that resilient economic growth and improving earnings provide a supportive backdrop for investors.
Thank you, Aymeric, very much indeed.
Thank you, Lorna.
And thank you for listening. Please visit our website for more insights and subscribe to our channel. You can search for BNP Paribas Asset Management updates for AXA. And if you like what you hear, then please do rate our podcast on your chosen platform. Thank you.